So here's one thing that I want you to think about as you are planning your estate, your will. Maybe you have a trust and those kinds of things. A lot of you have 401ks or IRAs that you've had from companies that you used to work for. Now you're taking your minimum required distributions because at age 70 and a half, you have to take something out, right? And you're doing that on a regular basis. But here's what I would suggest to you. You always want to think in a way that you want to avoid someday when the Lord calls you home. You don't want that IRA money, unless it's a Roth IRA, to go to your children. You don't want that to happen because they're going to have to take required distributions. They're going to get taxed on it. And of course, they got to pay your tax on it because remember, you have never paid tax on that money. The IRS wants your tax money. So you're going to have to pay it. They're going to have to pay it. They're going to get a lot less money than you think. Now, it's okay if it goes from spouse to spouse. That's fine. But you don't want it to end up in the hands of your children. So what you need to do is have a plan by which you are taking money out on a regular basis. I know you don't want to pay the taxes. I get that. But you cannot avoid it. So you're far better paying the taxes now in your current taxable situation. You notice I didn't say tax bracket. I said taxable situation because I believe this government is going to continue to find ways to tax that money. Maybe not through a tax bracket, but maybe through some sort of fees, disbursement fees, or other kind of fees. So I say start withdrawing it now. Use it, obviously, if you have a need for it, but move it over into your investment account or your savings account. It would make a whole lot more sense because then you can leave that account to your children. So that's an important issue. The other thing is, look, you have to make a decision. You have to decide if you want to try to disinherit your children. You don't want them to get anything. Or maybe you want to disinherit your favorite ministry or your church. Or maybe, like a lot of people, you want to disinherit the IRS. Well, you can't do that if you don't plan and take some action steps. One way you do that is maybe you need to have a trust. And a trust document, a living trust document, you don't lose any control of your assets. Nothing changes. Your checking account's the same. Everything's the same. You don't lose any control of it, even though those assets are now named in the trust name. You still control it because you and your spouse are the primary trustees of the trust, and you have total control. You can change or do anything you want, just like you can now. But your children are co-trustees or successor trustees. And someday when you go home to be in glory, your children are going to get that money because the trust is going to dissolve. And if the trust dissolves, they don't inherit the money. If you don't inherit money, you can't pay inheritance tax on it. That's the loophole. They just get the money because the trust no longer exists. See, your death is a triggering mechanism that disperses the money to the other trustees now. So that's all it is. There is no inheritance. That's the loophole. There may be reason for you to plan a living trust, something to think about. The other thing, and one of the best things you could do, in my opinion, is to give your money to the people that are going to inherit it anyway. Well, I don't want to do that. I feel like I'm losing control. Well, that's okay. Then you can give the control to the IRS if you want with that money, if that's what you'd rather do. But look, at some point in time, you will reach a place where hopefully, by the grace of God, you have more money than you're going to spend in the rest of your lifetime. It's time to start giving the excess away. And you can give $12,000 to anybody you want without them paying any gift tax. And obviously, it gets that money out of your estate, so you have a smaller estate. If you're threatened by the fact that you could go into skilled nursing facility, you're taking that money out of the estate so that Medicaid can't someday attach that money. Now, they have the right to look back for 5 years. So you have to be planning far ahead of a time that you might actually need to go into a skilled nursing facility. Your home, you can put it in the name of yourself, of course, so that you would have to sign. Nothing can be done without your signature. But you keep it in your name, but you have it in the names of your children as well. The deed, that is. So when you die, your children own the property. If one of them would die, then the remaining children own the property, and so on. When they sell it, they already own it. It gets divided up equally, and that's the end of it. There's not going to be any dealing with any kind of a tax. You should be gifting your money. You've got to be very careful when you leave money in your estate by way of your will to grandchildren. There's a generational skipping tax that they might have to pay. You want to be very careful of that. If you want to give money to your grandchildren, that's a wonderful thing. If you're able to do it now. Look, I'm a believer in giving all your money while you're living so you're knowing where it's going. And I think that is a far better strategy. Don't be afraid to discuss these things with your children. It's important that they know where everything is and know your wishes. But maybe you can have your wishes happen while you're alive by doing a little bit of gifting right now. I have seen people that have gifted and recommended that people gift a large portion of their estate to their children. And I have instructed the children that, hey, this was back when I was managing a lot of money. I'll open accounts up. That is your parents' money no matter what. It's not for you to spend. It's not for you to use. If you have trustworthy parents, you ought to think about that. That might be a good way of getting some money out of your estate. The other thing is you may want to leave a grandchild or children a charitable gift annuity or a charitable trust. Maybe you don't feel right leaving them a large lump sum of money. Well, leave them half of it. The other half, put into a charitable gift annuity, and you're buying them a pension so that someday when they retire, you will have bought them an income for the rest of their life. It's not something they can outspend. It's not something they can outlive. Every month, they're going to get an income check. It's a wonderful thing to do. I've used that over and over again in estate planning as a tool for planning. So something else to think about. The other thing is, as far as your giving and your withdrawals, think about withdrawing money now, doing a charitable gift annuity or a charitable trust as your final gift to the Lord's work. I hope all of you are going to make a provision in your will to give your final tithe, maybe to your church, maybe to the Lord's work somewhere else. One way you can give to the Lord's work when you die, but do it now, is through a charitable gift annuity. If you have the means to do it, don't hesitate. It's not something you need to think about. Do it. It is a great planning tool. You're going to get some tax deduction for doing it. You're going to get a lot of tax-free income for doing it. And you're going to get income for the rest of your life. And then when you die, both of you, if you're married, when both of you are gone, that money's going to go to kingdom work. It's a great planning tool, something else you should use. But look, we can't take advantage of any of the tools that are out there in order for us to plan properly if we don't do it now. It can't be done later. Don't be afraid to talk about planning with your children and start doing it. And here's the thing I want to emphasize, because I know this is a concern that you may never say to your children. You cannot lose control of the money through proper planning. In other words, you get to spend what you want to spend. You get to do with that money what you want to do with it. It is never going to impact your ability to use your money to maintain your quality of life. but it's going to give your children the ability at some point in time, to save taxes and to use it for your benefit when your health may start to get poorer and you no longer can control certain things or want to or need to or should be. And that is the other benefit. Make sure you're planning. Make sure you're talking to your children.